In this week's update, US bull market remains in full swing despite the Trump uncertainty. Ensuring your process fits with your objectives, and Bitcoin a week to pause. My name is Garry Davis and I'm an authorised representative of Primary Securities. The information is general in nature only, and any advice is general advice only. Your personal objectives, financial situation or needs have not been taken into account. Let's start with a quick market perspective because it was a bit of a quiet week really with Thanksgiving on Thursday in the US, and then it seems a lot of people just took the rest of the week off because Friday didn't see a lot happen. So we probably won't have a lot of action stemming from the US when our market opens on Monday. Just looking at US tariffs, it's pretty clear what Trump is going to do. There could be significant risk to certain industries like the auto industry, energy, electronics. It's almost certain the supply chain is going to be disrupted. So the only word that can be used is ongoing and probably increasing uncertainty. And that means two things. One, you need to be just that much clearer and that much better at executing your process if you've got one. And secondly, you need to work off the charts and less off the fundamentals, because the charts are going to tell you where the money is flowing, and the money is going to flow to those areas a long time before you see it, either in announcements or in the way that the Trump administration conducts itself. So trying to react to the news, I think, is going to be a losing strategy for the next 4 years. You need to get out ahead of it. That means you need to be really observing what the money flows are doing and hang off those coattails. It's a market also to regard through somewhat of a contrarian lens. What I mean by that is, if something is done really, really well, you don't want to get out of a very promising trend prematurely, but you want to be alert and you want to understand what the signal looks like to take some exposure off the table. And then, of course, if you've got high-quality assets that you're tracking, then a significant pullback through fear, uncertainty, unknowns, whatever it might be, could be just a wonderful opportunity to get into some assets at a bit of a bargain basement price. So I think when things are going along really well, you want to be on alert to perhaps reduce your exposure. And when things aren't going quite so well, be alert to the opportunity there as well. Bitcoin almost got to 100,000 last week. It was unable to break through, pulled back to the low 90s. So a bit of a week of consolidation and finished at 97,500, still very, very lucrative. And there are numerous ways to benefit from Bitcoin. I touched on it last week. And as I've been indicating for quite a few years, not been a fan of Bitcoin because I try to deal in as close to what I can find as near certainty in the stocks that I buy. But I think we've reached the point now where Bitcoin is so widely accepted and utilised now that I think I'm now put myself in the category of being a reluctant believer. And the potential upside, if you believe the hype, is quite extraordinary. I can't accept the hype. It's just not in me through, getting on towards 4 decades of experience in the market. Some of the numbers that are being talked about are just cloud cuckoo land for me. But in the fullness of time, I might be shown to be wrong. Anyway, we shall see. But I'm now a reluctant believer. And again, just as I mention every week, we're in an age where increasingly it gets harder and harder for investors and traders to make money. It's easier to lose money than it is to make money in the stock market, and I don't believe that's going to change. We're in the middle of the bull market, which makes it a bit easier, but it's going to be extremely volatile. So you really need to have your process sorted out, and you need to make sure that you've taken whatever other advice that you need, be it financial, legal, or any other advice before you take action. Let's look at the American stocks. The S&P 500 was up 1.1% for the week. The NASDAQ added 0.75, and the Russell 2000 added 1.3. So a tidy week, given it was really only 3.5 days of trading. Now, just a number that I saw a couple of days ago, which is food for thought. Apparently global military spending in the last year is estimated at $2.4 trillion. How they do that is beyond me. But anyway, that was the number that was quoted. I can't say that it's valid, but that was what I read. With 32 active conflicts around the world. So it just gives you a sense of the size of the military spending. Now, Trump has said he can stop wars in a day. I doubt that. But anyway, he's going to try and stop wars. He is in some areas going to be cutting the expenditure, but in some other areas he's saying that America needs to beef up its military strength. So I'm not quite sure how all that plays out. The contrarian in me sort of feels like there's a lot of negativity around the aerospace and defence sector at the moment, and it just feels like if we get a bit more weakness, there could be a contrarian opportunity in that sector. So if you're trying to invest in the US, that might be one that is currently a bit under the radar. The US dollar had a fairly sharp reversal, was up in the 107s last week, back down to 105 this week. The 10-year yield also dropped sharply from 4.45 down to 4.17. And the VIX also dropped from the high 15s down into the low 13s. So that was the way the American market looked last week. Now, if we start with the S&P weekly chart, so you can see 3 of the last 4 weeks have been quite solid gains and closed on their highs. Just the 1 week where we traded down, and we're trading quite comfortably above the 20-week moving average. So things continue to look very solid in America, despite all the uncertainties around what the new administration will do. The market just rolls on. It doesn't seem to be too fazed by what Putin has to say or what China's doing or anything else. It just rolls on. Right, the NASDAQ, again on a weekly chart, up a little bit and very, very close to the highs set a couple of weeks ago. Semiconductors are in a fairly decent size sideways pause at the moment, and that may continue for a little while. Now, if we look at the sectors over the last quarter, business consumer discretionary, heavily influenced by Amazon and Tesla, admittedly, so water that down a little bit, but that's where the strength has been. We've also seen very good strength in communication services and also in the finance sector as well. And then we've got down in the middle of the pack, we've got technology, because some of the big tech stocks have certainly been held back a little bit. And then in the middle, we've got energy and staples. So this is still a very bullish setup. Okay, we've got healthcare at the bottom, which one would think can either be regarded as more of an aggressive or a defensive sector, depending on what parts of it that you look at. But you've got to look at those money flows, and you can only conclude that the American market, in terms of money flows, forget about the rhetoric, is still in bullish and highly aggressive mode. Turning out of the Australian market over the last quarter, the information technology sector remains the leader, has had a big dip when we got a sell-off, particularly in WiseTech Global, but has very, very sharply bounced back, and there's a lot of very, very good performances. And I'll touch on that shortly. Followed up by the banks, small caps, and then materials just having a little bit of a better week last week, but they're still lagging a fair way. And then healthcare and energy absolutely at the bottom. And energy in Australia is probably one of the worst sectors in the world that you'd want to be in. I've said it before, government policy in this country around energy for at least the last decade or two has been an absolute disgrace. It's no surprise that energy is underperforming in the Australian market. That's a sector definitely to stay away from. Okay, let's go and have a quick look at the Aussie market. So our dollar, 64.37 is where we finished. The ASX 200 was up 0.5% on the week and may add to that a little on Monday. Infotech and banks were the leaders. The sweet spot of the Australian market is really what I would term as expensive quality growth. It just continues to deliver, and I'll show you some charts right now just to make that point. All right, so a little bit of learning here. So this is car group, and these are not recommendations. These are just observations to reinforce the point that I'm making, because I see too many people, too many investors the stocks that they target are extremely speculative. And I just wonder about what their overall objectives are and whether there is a complete misalignment between what they actually do in the market and what they're trying to achieve. So I would really suggest that everyone thinks about what is your long-term repeatable objective. And if you don't know what's realistic, then you better do some homework on that to find out what is realistic and what's going to be suitable for you. The next question I'd pose is, does your level of experience make it likely that you can achieve that objective? I occasionally get questions from people that want to make 50 or 100% a year and they've got very little experience. Well, it's just not going to happen. And not without an incredible amount of luck, and luck is never a good strategy. So for a lot of people, they're just setting themselves up to fail because they don't have a lot of experience and they're trying to get a return using highly speculative stocks that are very unreliable. And so the chances of them getting a positive outcome are actually not very great. So just think about where the bulk of your investing activity goes. Is it going for the big kill? Is it chasing mostly speculative assets? And if that's what you're doing, then your chance of success is low. So then the obvious question from there is, could you do it far more reliably? And I would suggest that for most people, if you can get 25% reliably per annum over the long term, that is a fantastic return. Yeah, sure, you might get a really good year here and there, but can you do it repeatedly, year in, year out? Because if you can do that sort of level, you can triple your portfolio, or you will triple your portfolio every 3 years. You do that for a decade or two and you create a lot of wealth. So there's no requirement to smash the ball out of the park constantly. You're more likely to fail. And so I'll just show a couple of stocks, and these are in the what I term expensive quality. This is car group, total returns, which is capital gain plus any dividends over the last 1 year, 54%. Okay, that's a good year. But let's look over a little bit longer term. Over the last 3 years, 23% per annum and 25% per annum over 5 years. They are thumpingly good returns. So why wouldn't you have the bulk of your portfolio spread among these sorts of assets? And there's plenty of them. It's not like there's only 4 or 5 of these. There's plenty of them. You just need to know where to look. Let's look at REA Group. 60% in the last year, 17% per annum over 3 years, and 21% per annum over 5 years. That's an expensive quality stock, growth stock, that pays its way. P&E, okay, this is the pointy end, but there are others that are doing similar things. PME, 185% in the last year, 60% per annum over the last 3 years or 5 years, depending on how you want to measure it. So why not devote the majority of your portfolio to these kind of opportunities? And there are plenty of others, and we've got a number of them in the Insiders Club portfolios. This is not hard. It's just making sure that your process and the stocks that you target are aligned with your objective. Very, very important. So the bottom line is you can do really well without having to take a lot of speculative risk. It's just not necessary. Precious metals, gold, down $58 to 2,658, or a fall of 2.1%. And in Aussie dollars, that translated to just under $4,100. Silver was also a little bit lower at $30.61. When we look at gold stocks, it was a pretty disappointing week, to be honest, for gold stocks. And Bitcoin, as I mentioned, consolidating just under the 100,000 mark. So we'll go to gold on a weekly chart in US dollars. So you can see we did have a big dip. That dip occurred on Monday, but then we recovered about half of it for the week. There's the gold price in Australian dollars. There's silver, still just managing to hold above $30. And Bitcoin, that was what I wrote last week about considering if you're put off by trying to own Bitcoin itself, what Bitcoin ETFs removes all the hassle, removes the risk of getting hacked and all the rest of it. But you could also look at a stock called MicroStrategy. Is worth a look as well. That's not the correct code. I meant to confirm that exact code. I think it's MSTR. So that's also worth a look as another way to gain exposure to the gains in Bitcoin. And if we look at the GDX, which is the Australian ETF for gold stocks, a down week, but closed off the lows. And GDXJ was down for the week and didn't really do anything much on Thursday or Friday to recover those big losses that we saw earlier in the week. All right, that's the precious metals market. Turning to other commodities, copper and nickel were both pretty steady, not much movement there. And we've got Chile now bouncing back, the strongest production month of the year and the best since 2019. The delays in production there was up to some project setbacks, but they've been resolved, so that's not going to help push the copper price to the upside. But if you look at the bigger picture, what's going on at the moment is some multi-billion-dollar revamps of plants that are really aging plants. They've been in production for decades. And that is just not going to cut it. It's just not going to meet the future demand for copper looking, let's say, late 2020s out from there on in. So at some point, something has to give with copper. But at the moment, there are no signs of it. Crude oil eased off a little bit, about $1.50 or so, back down to 68.63. And frankly, there are so many conflicting signals. Poor old crude oil just doesn't know where to go at the moment. So wrapping it all up, if you want to get better results, it's not difficult. It's not complicated. It's not the thing that comes naturally. So just work with grey assets. There are enough of them. There are more than enough of them to not need to go into the more speculative areas. You do not have to hit the ball out of the park to have an outstanding year. Just work with great assets because some of those assets will hit the ball out of the park for you. Try to work wherever you can. Try to work with existing strong momentum. Stop trying to pick the bottom in stocks that are falling. It's not a high probability strategy. Try to look for small pauses in strong uptrends and pursue multi-stage entries. These are all fairly simple things, but they're not the things that come naturally. And as I said at the start, just ensure that your process fits with your objectives, because maybe you could just make it simpler and easier and faster for yourself than what you're currently doing. Portfolio analyst this week, it's taking stock, which is really a bit of a review of the previous month. Plus, we'll also be looking at sector rotations, and we'll also be looking at some trading ideas as well. If you haven't been in Portfolio Analyst, there's a $1 trial for 2 weeks. I think you get a great deal out of it. If you'd like to know more about what we do, there's my email address and there's more information on the website. I'll be back with you next Sunday. Cheers.